are having their annual spring meeting looking at the state of the African region. And there are particular discussions now surrounding the skills for success in transforming Africa.
Looking forward, we expect Sub-Saharan Africa to grow at around 3.2% in 2018 and 3.5% in 2019.
Right.
This recovery is powered by three important factors. One, capital inflows are back on the continent. In fact, we're seeing a regain in FDI, we're seeing a regain in sovereign bond issuance, and more importantly, we are seeing a narrowing down of sovereign bond spreads, right, which is signaling that there is a return in investors' confidence on the continent.
I want to interject.
Yes.
Where's the money going?
Well, interestingly, FDI is actually going into the traditional mining sectors, which is a problem. Now, the second important factor I think we are uncovering is that commodity prices that have actually driven down growth in 2016 are slightly recovering. They have stabilized at a lower level than in the past, but there is a slight uptick that is actually improving the conditions in our natural resource-led economies. And the third important factor that is driving the recovery is that our two giants, Nigeria and South Africa, who make more than 50% of our GDP, are out of the recession. They're still growing at only 1%. I'm not sure I should clap yet, but
as a South African, I think we need to clap.
Yes, we're out of recession. That's right. We're out of recession in Nigeria and South Africa. Nigeria has been in 15 months of consecutive months of recession. They're still growing at 1% for 2017, which is way below the potential, but it's already a good news. Now, the second important message, Lerato, is that, that low average, 2.4, is hiding a significant diversity, especially a geographical diversity across the sub-region. Countries in the CEMAC region who are essentially commodity-driven, especially oil-dependent, will continue to struggle, and growth prospects do not look very good. Now, countries in West Africa, in WIMO, are actually continuing their growth trajectory, powered by large and efficient investment in efficient public investment, especially in Cote d'Ivoire and Senegal. And we would see these countries continue to grow. These two countries grow at above 6%. On the Eastern Shore, growth is also on the right trend, where Ethiopia would remain the fastest growing economy in the sub-region. Tanzania, Rwanda are continuing to grow fast, and Kenya, of course, is also seeing a regain in growth. But why is all of this important, Lerato? And you are listening and you're saying, these economies always throw these numbers. But why is economic growth so important? It's because whether you are a student, a minister of finance, or anybody else on the street of our capital cities, if we can sustain economic growth, and especially if that growth is coming from a diversified base, the economy will create the jobs that we all need.
I think my question isn't, why is this important? My question is, what's new? What's new about these trends?
Excellent. Now, what is new? When we spoke last time in April, we had projected, a growth rate slightly above what we have now. So things are improving, but not as well as we have hoped they would be. But there are three things that are really new here. As I've mentioned earlier, we see a return in investor confidence, and that's something quite important. Okay. And this is stemming from a more favorable global environment, where we have seen higher global growth, higher trade, and also an easing of international financing conditions. Okay. Now, the second thing that is new is actually that fiscal space on the continent has tightened. In fact, our numbers show that 36 of our 48 economies have actually seen a tightening of their fiscal space over the past 3 years. This is serious, and this is serious because it's happening in a context of rising debt.
So for the benefit of our viewers on live stream, we are seeing a tightening of the fiscal space. Does that mean finance ministers are doing the right things now?
Well, a number of finance ministers here in the room would tell you these are tough times. These are tough times, and for countries that are commodity dependent, the need for fiscal adjustment is extremely serious, because as revenue go down and our countries not already being able to mobilize enough domestic resources to face or to compensate for those declining revenues, yes, it's a very difficult situation. Now, it's important to highlight that debt is actually rising extremely fast. Debt is rising extremely fast, and between 2009 and 2016, the average debt ratio, debt to GDP ratio for sub-Saharan Africa has increased by 15 percentage points.
Wow.
That is extremely worrisome. And it's worrisome even more because we have now reached a stage where sub-Saharan African economies have now surpassed the rest of the developing world that never got HIPIC. So our debt ratios are now above the rest of the developing world that never got debt relief. That's serious. And I know a number of ministers of finance may say, oh, my debt ratio is still below 50%. Why should I worry? But I think we should worry about this very, very steep rising trend.
Let me say something that might make me sound very, very leftist. But how do you respond to people who say, okay, having a high debt to GDP ratio might not be the most favorable position to be in, but if you're using that debt to do right things, if you're using it to build schools or hospitals, then it should be okay in the long run.
It should be okay, and as you said, Lerato, there is a big if. If that investment is used efficiently. If we are spending efficiently, then debt could definitely lead to higher growth rates. But the last edition, the 15th edition of the Pulse, has actually pointed to the fact that efficiency of investment hasn't been that high in a number of our countries. And more importantly, we have not always, invested the money we borrow. We have actually consumed part of it or most of it. And that's a problem.
I want to raise other trends that have come up, not necessarily in the research, but things that we're talking about. The Africa that we're imagining, the future that is unknown, is going to have many young people in it, already has many young people. What are we going to do about them, about creating opportunities for them, about empowering them?
Look, let me just step back and say, Africa has a huge demographic bulge. We all know 50% of our population is below 25. But sadly, Africa's workforce is one of the least skilled in the developing world. What does that mean? That means basically that despite increasing enrollment rate in primary and secondary school in our countries, we still have 1 out of 3 of our children who do not complete primary school. We still have less than 1 out of 2 kids who do not complete secondary school. And we have less than 10% of our population who complete tertiary education. That's not the kind of human capital that would take us to the next level. That's not the kind of human capital that would allow us, as our Vice President has suggested, to leapfrog. It's going to be very difficult if we do not do this. Now, what should we do?
Yeah.
What should we do? Our research is pointing to 4 important messages. One, it is crucial for our countries to take a hard look at public expenditure in education and make sure we make it more efficient. In fact, what is happening is that Africa is spending more than any other region on education. We spend in average 15% of our revenues on education, and countries like Senegal probably spend 25% or 20%, around 20% of their budget on education. You know, the average is 15% of our revenues. Close to 5% of Africa's GDP is spent on education, but the learning outcomes are not there. We are now entering what our recently launched World Development Report has called a learning crisis. We need to make sure our public expenditure in education focuses on what improves learning outcome. The second thing we need to do in our countries is to ensure that we invest in foundational skills. And what do we mean by foundational skills? We mean literacy skills. Our population needs to know how to read. We mean numerical skills. We need to know how to count. More people need to. It means also socio-emotional skills, which we do not always teach in our schools, but that are extremely important for adaptability and to, set goals and become more ambitious in creating your own job or managing it better. We need to make sure we invest in those skills for all our people. The third important thing countries can do from our research is to strike a right balance between skills for productivity and skills for inclusion. Skills for productivity would have to be cutting edge. And here we need to really push the teaching in science, in education, in mathematics, And I was quite struck when I visited a country recently to hear that the percentage of kids graduating from high school in math and science was less than 2%.
Wow.
That is a crisis. That is an issue we need to tackle.
Okay.
Right? And I think it's even more important to ensure that we also, as we push for skills for productivity, include all age groups. The Vice President has mentioned adult literacy, local languages. We need to make sure all the age groups in our population are covered by this education. Okay. And last point, if you allow, as we start to invest in skills, it is important in our countries to ruthlessly focus on making skills provision demand-driven. It will not help our countries, especially in these conditions where fiscal space is tightening, to create thousands of skill development centers or vocational training centers that have nothing to do with the demand of the private sector. We need to involve the private sector into this equation.
Thank you very much.
You're most welcome.
Call to action, ladies and gentlemen. Thank you, sir. Okay, so that's food for thought.
Well, that was the World Bank chief economist, Mr. Albert Zufak, speaking there to the BBC's Africa Business Report, Lerato Mbele, on the skills for success in transforming Africa, pointing out three very important issues that Africa needs to have more efficient public expenditure in education, and that the continent needs to invest in foundational skills, and also to strike a balance between skills for productivity and skills for improvement. And the last point he was making there, that skills must be demand-driven and should cater to the needs of the private sector. So that were some of the discussions coming out of the World Bank and IMF annual spring meeting currently on in Washington.